From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last day of February 2025. On the calendar, well, Saturday we enjoy PBR, not Pabst Blue Ribbon, but professional bull riders at the Fiserv. It'll probably take a couple of days to clean up after those bulls. And then on Wednesday, it's the Bucks welcoming Dallas to town. And this is the last weekend to check out the latest rides. Not bulls, but cars. The auto show is wrapping up on Sunday. I'm hoping to take my grandson, and maybe he'll buy me a car. So what's in a name? Nothing if it's null. Can you imagine your name is Null, N-U-L-L, like the person in this story? He enters it in every form he fills out. Then the computer reads null and voids the form. It's null and void in the simplest form. Poor Mr. Null has to get a living and breathing human on the phone to tell the computer it's wrong. No wonder his wife kept her maiden name. Let's just say computers make some of us dumber, not smarter. Here's a viral trend on TikTok, where TikTokers drop heavy objects like toasters, air fryers, vacuums, wooden tables, etc., onto their feet. Why can't they just go back to eating Tide Pods? And finally, Japanese scientists at Tokyo University have studied chimpanzees for 600 hours and have learned that chimps like to pee together. This answers the age-old question, what did you do at work today, dear? On the podcast today, we have Adam Baley, Tom Pappenfus, and wrapping up the week, here's Kyle Tetting.
A few things I probably didn't need to know today, Max. Thank you. Tough week overall for the NASDAQ, down 3.5%, down 677 points this week, closing at the bell on Friday at 18,847. S&P 500 down 1%, that's 59 points on the week. And the Dow Jones Industrial Average, after a very sharp rally the last 2 hours of the trading day on Friday, up 1% on the week, 413 points, adding 601 Friday, and again, all in the afternoon, to close at the bell, 43,841 on the Dow Jones Industrial Average. For the year, Dow up 3.3%, including dividends, S&P up 1.4%. NASDAQ now, after a rough week, back into negative territory, down 2.3%. A quick look at the week. Tom, maybe the place to start this week is just that sharp contrast between what we saw on the NASDAQ, down 3.5%, what we saw on the Dow, up 1%. The S&P maybe kind of splitting the difference, down 1%, but, I think couldn't be a starker contrast year to date between what we're seeing on some of the stuff that had been doing well, some of the stuff that was doing a lot of the heavy lifting, and maybe some of the stuff that, whether it's more defensive or just a little more old guard in general, certainly has held up a little better.
Yeah, I think, it's really been a very symbolic start to the year, and kind of what we're trying to do with all of our accounts and for our clients is to preach diversification. Nothing could be more true now than what we've always talked about for years. And to your point, what we're seeing is certainly a rotation into safer parts of the markets. Talking to clients and just highlighting the fact that defensive sectors are doing really well this year. I think it's led by consumer staples, utilities, financials, healthcare. The gap in performance now, year to date, depending on what day, I believe the large growth, Russell Growth Index is down about 3.6%, while the value index is up about 3.4%. So I think, one of the things we kind of, what does this all mean? And I think part of my talking points right now is this part of something lasting? Is this more an ominous sign, right, of is this rotation? People are taking obviously more defensive positions, going to perhaps lesser value companies. Is that a worrisome sign that, well, they're worried about prospects for growth? And it may or may not be true. I think what we can lean on is that actually, historically speaking, some of this rotation has actually been almost like maybe a wayside rest for this bull market not ending, but continuing and just finding, more broadening out there into other areas of the market.
I've seen the rotation this year as something natural and also healthy. You look back over the past several years, and tech stocks have just led the charge. You've seen that with the NASDAQ, where it's just outpaced everything, in part because earnings growth had come from that area, but now prices are just so high, the valuations are so expensive. In our world, when something can be that expensive, it's also vulnerable to a decline. And you mentioned a rotation into the safer areas of the markets. I'll rephrase. It's also a rotation into the cheaper areas of the market, where you're just getting businesses at a fair price, if not a better than fair price, less than average. So it's good to see some natural and some healthy rotation take place. Gosh, it feels like that's something we've been talking about for like the last year or so. And sure enough, now you have a divergence where the Dow, those sleepy dividend payers, the global industrials, are up 3.3%. But those technology businesses, so far for the year, down 2.3%.
You know, the NASDAQ early in the day-to-day, before we got the kind of late-day rally, was flirting with maybe 8.5% off recent market highs. And that to me is a pretty clear indicator that investors have been a little more hesitant there. They've been, what I would argue is more willing to take risk off the table right now, more willing to capitalize on gains. And we've seen it in fund flow data, Adam. We've seen kind of investors saying, hey, stocks are expensive. And while we very much believe that long-term stocks are the answer, that there's better than expected returns, better than average returns coming from stocks compared to other areas you might want to put your money, at the same time, we have to invest in the environment we're currently in, an environment in which we do have to pay up for stocks, and in which there are other asset classes that maybe look a little more attractive, things like bonds. And so, you see money all year now going on, a number of consecutive weeks flowing out of stock mutual funds, stock ETFs. The reverse of that, you see those bond mutual funds and ETFs seeing some inflows. And I think, maybe it speaks to kind of the bigger picture of what we've been trying to do for clients, Adam.
Yeah, I'll mention briefly just, where money kind of has flown out of. When there's nothing more quintessential this week than I think of NVIDIA. You look back at their earnings this week, they had a very good earnings number. They beat top line, bottom line. It was good all around, yet the day after, the stock sold off 8.5%. I mean, it just goes to show you maybe perhaps some irrational exuberance kind of built into those expectations, where even after delivering a good earnings number, the stock sold off just because expectations were just so detached from reality. And investors have pulled back on growth, and where are we finding some opportunity? We're finding competitive returns in bonds where you can get a 4.5%, 5% yield on high-quality short-term debt. You can also get north of 4% yield on cash these days. And I haven't been able to tell clients that for 20 years that you've got more than a 4% return on your money market. And I think now's a wonderful time to just revisit doing some risk reduction moves in your account, doing a reassessment of risk, and doing some rebalancing while the market is near all-time highs. And that's kind of where we've been the past couple months.
Well, it just kind of seems as if the momentum trade is kind of stopped, right? I mean, fundamentals haven't changed. Companies are still profitable. We're still seeing plenty. Now it's just people are acknowledging the fact that the value index is also representing 10% or forecasting 10% earnings growth. So now it's like, okay, well, this has been here, but now people are acknowledging and saying, well, that's attractive in this kind of environment. And perhaps the NVIDIA buyers, maybe they're happy with the several 100% gains they made, and like, well, I don't, my position went from 10,000 to 30,000. I don't need to own 30,000. It's never my plan for NVIDIA, but now they're peeling back, and not that because they're maybe dismal on the prospects for growth, but it's just they now own too much of it.
No, I think that's fair. And amidst the selling we've seen the last few weeks, amidst all the uncertainty, we've seen bonds doing exactly what we would have hoped. You saw the yield on the 10-year Treasury move from about 4.6% 10 days ago to now in the 4.2 range. I think it's a very telling sign that investors own that part of their portfolio for a reason, Adam, that bonds in a 2-week stretch in which we've seen stocks sell off pretty substantially, your bond funds, as long as you stayed fairly high quality, have probably made some pretty decent money.
And that is a reassuring thing to see as a long-term investor, that normal, healthy market forces are taking over. That was not the case in 2022 when everything was down simultaneously. Now, as stocks have sold off a little bit, specifically technology stocks, bonds have had their day in the sun. And it's really good to see because it's just a normal, healthy market force taking over.
You know, Adam, with Joel out this week, a kind of big week for economic indicators. I know we all did a little bit of work there, but I know you tend to dive in a little deeper on some of these. For me, the week kind of started with the consumer confidence numbers taking a pretty big dive, going back to levels we haven't seen in a while. And I think when we talk about, what drives economic forces, and I think the consumers being such a big piece, it's kind of important that we understand how they feel.
Yeah, thanks for the responsibility to fill Joel's shoes this week. Some big shoes to fill. But let's go through some of the economic news. And you're right, I started there with consumer confidence this week. A sizable drop, 7-point drop from the previous month. It is rare to see a drop of that size and magnitude outside of a recession. It's also coming on the heels of last week's consumer sentiment number, which was down 10%. By the way, if you're going to ask the question, what's the difference between consumer sentiment and consumer confidence, there is none. It's just the way we differentiate the two reports.
They are spelled differently.
Yes, spelling, thank you. But it shows that consumers are really showing some fatigue here and pulling back in their consumer spending. And Kyle, you and I were talking before we started the show, but one of the things that caught my eye this week was a report out by the Wall Street Journal on consumers and consumer spending, which, by the way, drives 70% of our economy, which is why we focus on this so much. But of consumer spending, 50%, half of all consumer spending, is done by the top 10% of households here in the United States. And if you see a drop in consumer spending, given that such a small group of people can command an outsized effect on consumer spending, it can certainly have some lasting impacts. And we're just starting to see some of that materialize now.
And I think it's fair to say that at least for the last couple of years, that part of our kind of population has been in a very strong position. They've been able to demand higher wages largely across the board, many of them entering those retirement years, as we've talked about. And so there is a fairly solid backstop for spending long term. But if the consumer's feeling a little bit grumpier, whether that's confidence or sentiment or however you want to measure it, it might not call into question their long-term ability to spend, but it might change the timing of that spending a little bit. And maybe they say, you know what, I'm going to hold off on that new fridge. I'm going to hold off on that new stove because I want to feel a little better before I dive in.
Well, you just set up the durable goods order that came out, and also personal spending. For what it's worth, personal spending declined 0.2% month over month. Not exactly what was expected, but I'll go back to durable goods orders. Durable goods orders did come in positive, up 3.1% from the previous reading. The gain, however, was not led by consumers. Consumers were flat. The gain was attributable to essentially a single thing, aircrafts. And here's what you need to know, right? You order 4 new aircrafts, there's $2 billion worth of spending. So it's good to see that durable goods orders were up, but it came from aircraft, not from consumer spending. Maybe just kind of tying into some of the glumness that consumers are feeling right now.
Yeah, and I think that's always part of the fun in this economic data is looking at two things. One, kind of trend. It's one thing to say, okay, here's what happened this month. It's another to say, here's what we've been seeing. But the second is just the amount of nuance that goes into this data sometimes, because that personal spending number you were talking about, well, it came at a time in which January tends to see a lot of weather issues. We're coming off of a month in which December was a pretty good month for consumer spending. It tends to be anyways because of the holidays. But comparison points then get a little wonky. And so it isn't as simple, at least for 1 month, as saying, hey, the numbers were down. But I think you start to stretch a few of those together, you get a little more nervous.
And you can see that not just in consumer spending, but also in home purchases. There's a seasonality to all of this. Fine. New home sales were down 10% month over month. Pending home sales were down, closing in on 5%. But then again, like, who's really going out there and building a house in January or looking to buy a house in January or February? There's a huge seasonality to all of this. So you do have to take it with a grain of salt.
And then buried in that personal spending, we get some personal consumption expenditure numbers, the kind of Fed's preferred measure, signs that in December into January we were seeing some slowing of inflation, albeit modest on a year-over-year basis. Still not back to Fed target, but an encouraging sign that at least a little bit of a trend we had seen in an uptick. Inflation seems to have moderated.
Yeah, Tom, you mentioned just the fundamentals remain solid, and you're seeing that with still historically low interest rates, cooling inflation, albeit a little bit sticky, but also some rising profitability. And I think those are the three things that kind of tie in. We certainly saw that with PCE, where inflation is still cooling from the lofty levels we had before, yet a little bit sticky in pockets.
Well, it seems like with the inflation being moderate, still moderating, I guess, it's interesting to note the Fed funds rate potential for rate increases in June is now at about maybe 2 is forecast for the year, at about 70% probability in the futures market. So we're getting a little bit of mixed information. So with the consumer confidence, consumer sentiment, being gloomy and almost maybe perhaps a predictor of where we see the economic trend, perhaps maybe economic slowing being a concern, but with inflation also going down. I guess I'm saying all this in relation to where we think interest rates maybe go, because we have if we have inflation declining, we probably are looking at, or I should say, if we're worried about the economy weakening, we may need to increase rates. But if inflation is coming down, then we're looking at declining rates. So now we have kind of two opposition forces that are starting to come into play right now. And, it'll be interesting to see how this kind of plays out as time goes on.
All of this conversation, and none of it touches on the uncertainty driven by politics. I think I get that question often enough of whatever side of the aisle you're on, what's this political environment going to do? Short term, certainly it's added a lot of uncertainty, and I think that could be part of what we're seeing in some of the economic data, Adam, especially the more recent stuff. You look at those sentiment or confidence numbers, and we saw a pivot from Republicans feeling like the economy was terrible to Republicans feeling like it was great, and Democrats vice versa. But also, those kinds of shifts are pretty typical. And I think the uncertainty piece is the piece that near-term creates some havoc, creates some potential concern. Longer-term, business executives, CEOs, CFOs seem pretty optimistic about what policies are set in place in terms of what it means for their businesses. I think the recognition there is more about the fact that it's really hard to get meaningful change passed than it is about any specific policy that we see coming. But again, I think you've seen plenty that would indicate that, hey, we got some things to keep an eye on near term. It's why for everything we talk about, whether it's good or bad for the economy, good or bad for markets, we kind of continue to rely on that balance as the key to how we build portfolios. Well, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.